Daily Energy Markets podcast. I'm delighted today to be joined by Neil Atkinson, former head of oil markets division at the IEA, Jay Maru, head of market intelligence and analytics for the MENA region at Vortex, and Vortexa, not Vortex, and Andrew Critchlow, head of news for EMEA at S&P Global Commodity Insights. Thanks so much, gentlemen, for joining us today. It's been quite a week on the energy markets. We've had the COP28 here taking place in the UAE, but more importantly, some real action on the OPEC Plus front and real reaction. There we have one of the survey questions that we've put to our audience earlier this week, actually, just when OPEC had announced its additional cuts. And clearly, the intention has not materialized yet. Neil, let me go to you first. We've seen Brent dropping below $75. And quite a decline this week alone. And, all in the context of OPEC Plus coming out and trying to continue to support this market. So what's going on?
Well, it's a simple matter of supply and demand. The demand growth that we've seen for the large part in 2023 has been pretty impressive. But then again, it would be because we were rebounding from the COVID crisis, particularly in China. There is some doubt, because Chinese data, as always, is pretty opaque, as to how strong actual consumption, end consumption in China has been and is. Meanwhile, on the supply front, which is, I think, really where the main action is, we've seen a big surge in US production. We've seen a big increase in Iranian exports, which I think has taken perhaps most of us by surprise. And on the wider issue of non-OPEC supply, we're seeing very, very strong growth, and that's expected to continue into 2024. So, weaker demand than we might have thought, although we shouldn't maybe use the word weak. It's not as strong as we thought before. Plenty of supply. And, there's, in the immortal words of Sir Michael Jagger, OPEC can't always get what it wants. And, it can't make water run uphill. And this idea of $100 a barrel or $90 a barrel is for the birds. And they have to accept, for the time being, a price range at a lower level, within lower bands than they might have thought they would get a few months ago. I think it's simply the fundamentals.
Okay, thanks, Neil. Andy, let's go to you with that. It was just about 6 weeks ago or more, before the tensions even in the Middle East emerged, that we had some people saying, oh, we're going to see $100 again before the end of the year. And we still have bulls out there saying, whatever's happening now is happening, but there's only one way, and that's up for oil prices, because oil is cheap, right, relatively speaking. So, where do you think that's going? Are fundamentals now really kicking in? And what should OPEC, what could be its next step, having just taken the last one? Can it do anything else, or just accept its fate, as Neil said?
Well, let's kind of start with the final part of that question. A lot of it depends on economic growth going into Q1 2024 and the whole of 2024. It depends how you read the runes. You have falling inflation now in the OECD. Central bank seems to have got that problem under control, and you've got falling yield curves for government bonds. So, one side of the equation, you could interpret that as being, bearish actually for global economic growth. You could say, well, actually, that's, a signal that consumption's falling, that there's general weakness in demand across major economies, and that's going to hit oil going into 2024. Our forecast, the S&P Global Commodity Insights forecast for the first quarter of 2024 and for the whole year, is for demand growth to decline. Although total net demand will reach a peak above 104 million barrels a day. So, it is a weaker picture overall. But then the other way to interpret that is actually, falling inflation, lower borrowing costs as central banks start to ease off tightening monetary policy, that could be quite bullish for crude going into 2024. So, as Neil alluded to, there's a lot of uncertainty around the direction of global economies. I tend to think the issue is more around demand now, and that's going to be the major factor, because OPEC's done everything that it can do. This is coming to the first part of your question. I think that this last meeting that we had last week was incredibly dysfunctional. I think it showed that OPEC as a body is if not fragmenting, but under a tremendous amount of strain. A significant gulf has opened up between, albeit peripheral African producers and the core Gulf producers in terms of baselines, in terms of overall direction of policy. It is very unusual how the Russian President Vladimir Putin has come to the Middle East literally days after that OPEC meeting, and at a time when I think dated Brent closed yesterday down 4.5%, trading well under $80 a barrel. For economies in the Gulf, that just doesn't rub at all. Saudi likely entering into a recession in 2024. The UAE, the more high spend economies in the Gulf are going to struggle to generate oil-driven surpluses, which are essential for their economies into 2024. So there's a lot of pressure at the core of OPEC as well around pumping up this price. So lots of problems ahead.
Yeah, and I mean, I suppose the expenditure plans, particularly in Saudi, but a lot of people are also saying it's not obviously doesn't have a lot of debt, and it should be fine to continue to sort of fund those plans. They're not at risk, but clearly they want to maintain a certain minimum on the price, and are trying their best. Jay, just on that point, let's stick to OPEC, the OPEC story. Is Saudi sort of stuck between a rock and a hard place now? It doesn't want to continue to take the brunt of more cuts, although it's just committed to more along with others. And the Russia angle, part of the agreement and part of the interview that we saw with the Saudi minister, at least earlier this week, oil minister, was that we're going to start to now really monitor what Russia's doing, what's it producing, what is it really exporting, what's it cutting, because we need to, because that enough is enough. Is it enough is enough? Do you think are we going to be able to monitor Russian oil on the water? A lot of it goes through pipeline anyway as well. Where's that story, do you think, developing as we go forward?
Yeah, I think the Russian story is a really interesting one for a number of reasons. If we look at where outright prices are now, I think just yesterday, the price for Russian oil assessments actually is teetering ever closer to below that price cap level. So that could facilitate more exports. It could facilitate easier exports across the shipping chain to allow that to happen. Now, if we look at what's happened with Russian exports, at least in the past couple of months, what we have to bear in mind is that one of their largest customers, India, the largest refinery in the country, Jamnagar, has been out for maintenance. So that's obviously crimped demand for that grade. At the same time, also, we know what's happening with China. They've reduced imports at a total level in recent months. And actually, what we saw was, for the first time this year, we saw a year-on-year decline in China's overall oil imports. So that once again feeds into that wider picture of weaker Chinese macroeconomic demand. Now, looking forwards with Russia, I think one thing that's been clear to us, at least internally, based on the research we've done, is looking at the way the exports have come out on crude, and also looking at what they've done on products. We don't really think that 500 KBD figure that was talked about as initial production cut has materialized. We think it's probably closer, somewhere in the order of 150 to 250 max. Obviously, there are seasonal swings in refinery output. But yeah, the levels that had been initially publicized versus what we saw on the water and our own flows, they don't tally to one another quite correctly like that. Looking ahead into January, one more thing I would say is we could see a more dislocation in the supply, potentially when it comes to the winter months. Obviously, we start seeing ice develop in the Baltic states, so we start seeing some more potential STS activity, the use of longer logistics chains. So that could see the turnaround of Russian flows from export to import levels elongate. But yeah, that's where we see things at the moment.
Okay, thanks, Jay. Neil, just back to you on, let's talk a bit about supply again. I mean, you mentioned Iran, which, yes, it has been production has been creeping up there for a few months. It's going to be hitting a certain level by March. They've been using that as a sort of date. But US production as well is back on track, isn't it? It's kind of made a bit of a maybe surprising comeback. Am I right in sort of saying that? And that people were sort of saying it's not going to hit the 13 mark again. And now we're talking about, more exports coming out of the US and a real revamp there. Where's that story? Is that a concern for OPEC, do you think, in terms of market share? And what are we going to see as a result of that going into 2024?
Well, it is a concern for them, yes, because the apparent strength of US production has taken most people by surprise. We were expecting an increase in 2023, and we expect further increases in 2024. But the size of the increase in 23 has definitely taken them by surprise. But I think a little bit of context here is that there seems to be a little bit of doubt as to exactly how high US production is because of changes in the statistical methodology that the Energy Information Administration has been using. And we're not going to get too much into the weeds on this, but there is a doubt of a range of 200,000 to 300,000 barrels a day as to what US production actually currently is. But leaving that aside, the US remains a growth story. There's no question of that. And even though prices are falling back, and even if you believe that prices in roughly the current range may be here to stay, then that might perhaps suggest that the growth in 2024 from the US might not be as stellar as we were thinking when prices were closer to 85 or 90. So perhaps in some respects, lower prices currently might bring some relief to OPEC as we move into 2024 from lesser growth on the US. But we've learned in the past that US producers are far more resilient than people think. And there is no direct correlation between prices rising up or down and US production going up or down by X thousand barrels a day. So, US remains a concern for OPEC, of course, but they shouldn't be surprised.
Okay, thanks, Andy. Let's talk a little bit about gas. We'll go back to oil again, but just to, in terms of Europe, and you've just been hit by a major cold spell across the continent, but the UK as well. And everyone was quite relaxed about the gas situation until quite recently, of course, with the proviso that okay, well, it depends what winter weather happens, etc., materializes. Are we still in a comfortable position in Europe in terms of gas supply, gas prices, given storage, etc.?
Storage is quite healthy, even with the recent cold snap that we've had in Europe. And the EC is formally, proposing extensions to last year's measures anyway, and that, relates to price caps, renewable permits for member states. And approval of that extension, I think, is due at the end of this year. So I think that in terms of consumers here, that there's a lot of awareness that they don't want to be in the same situation where we had prices rocketing above 300 euros, as was the case in late 2020 or early 2022. So we're a long way off that. There's more resilience in the system, and there's more LNG flowing into Europe. Of course, that can change, with the weather forecast, which is, really key to determining now where prices go in Europe for gas. But overall, I think that stress that we saw in the system beginning 2022 into the beginning also of this year, that's been resolved.
Okay, thanks, Andy. Jay, let's talk a bit about demand. Go back to demand for oil, China, just in terms of the flows we're seeing, imports, crude imports into China. It's obviously been building up its inventories. Now that the price has dropped, do you think we'll see them sort of come back in and sort of keep that up for sort of stock reasons, if you like, putting aside demand and how its economy is doing, and also what does the picture look like for product exports in China? In terms of, those quotas. So, would we see China now take advantage of prices dipping below 75?
Yeah,
Brent?
good question. So far, we really haven't seen that kind of spur in opportunistic buying. We've seen the opposite actually. So if we just focus on the most important independent refiners in China, those based in Shandong province, those which are typically the most price sensitive. If we look at what's happened there, oil imports for that region have really been falling, and at the same time, inventories have been drawing down as well. We see that trend continuing, and one of the key things with this region is it's the region that's most active when it comes to buying the more difficult to buy crudes in the market. So your Russian crude, your Venezuelan crude, Iranian crude, and especially in the case with Venezuela, they've become very price sensitive to the fact that Venezuelan crude now isn't as attractive to Chinese refiners as it was before. In the same way, Russian crude now, once again, given India's appetite now post refinery turnaround, is more attractive to a wider range of buyers as well. So from the Shandong side, that buying interest has really faded. Now, if that comes again in January and February, if prices continue their current trajectory, then yes, that could be a reversal. But as for now, we don't see that kind of spur in buying activity yet, given the current price fall. On your next question on product exports, so one thing that the market was looking for, or kind of hoping for in some ways, was if there would be another kind of extra batch of Chinese product export quotas for the fourth quarter. Now, that hasn't really materialized, and what that basically means is that product exports from China look pretty weak and are likely to remain weak for the foreseeable future, and definitely much lower than they were last year. We see a little bit of an uptick in gasoline exports from China, and we have seen that there was this new introduction of a fuel oil import quota to kind of facilitate that a little bit more. But yeah, in terms of overall product exports, yeah, it's generally weaker on that front.
Okay, thanks, Jay. Neil, let's talk a bit about sort of the macro global picture, because China, for all intents and purposes, this year has had an okay year. There's still been healthy growth, but of course, everyone's saying it's been disappointing. But it did just have a downgrade by Moody's last week, which didn't really cause too much of a stir. But from an economy, you mentioned macro and economic outlook. You said the U.S. economy is ticking along quite nicely, but actually, others would say that those rate cuts are now starting to bite. They will definitely bite into next year. We will see a shallow recession in the US. Do you agree with that? And so from a demand point of view, US, China, what's the outlook for 24? You're on mute, Neil, sorry.
Sorry, I was trying to be clever and look at a chart that I made at the same time as talking to you. I was looking yesterday at the OECD economic outlook that they published, I think just a couple of weeks or so ago now. And looking into 2024 and 2025, we're looking at growth in economic growth in the OECD countries, well below the averages, the long-term average. I mean, we're looking at economic growth in the OECD of below 2% in 2024 and indeed in 2025. And if you look at the non-OECD countries, which obviously are a long-term economic growth story, you're looking at growth there, which is only just above the global long-term average for economic growth in the last 10 years or so. So you could describe the overall economic outlook as being fairly gloomy, which is obviously not going to help ultimately the strength of oil demand in 24 and into 2025. So yeah, the interest rate hikes that we have seen, obviously they take time. I mean, you announce an interest rate hike on a Monday, you don't expect the economy to start reacting immediately on a Tuesday. But we are seeing gradually the cumulative impact of interest rate rises, the possibilities you mentioned in your introduction just then of a shallow recession in the United States and indeed elsewhere, that remains omnipresent. And that will obviously impact on the lower than expected, or perhaps a lower than expected growth in oil demand. But currently, based on the numbers that the agencies have been putting out in the last few weeks, we are still expecting oil demand to grow next year by up to about 1 million barrels a day, just under 1 million barrels a day. So, you could argue that that is not too bad. It's not exactly the oil market going into a recession. So we'll obviously have to wait and see. And we're obviously on the verge of perhaps, if we are in a new oil price range, we really are talking about significantly below $80 and possibly even $70 for the next period. You can well argue that that might provide a stimulus to the global economy or to oil consumers that would be very welcome.
I mean, that's OPEC's dilemma, isn't it? Always. I mean, if it keeps pushing prices up, then it will be killing possibly demand. So it's a fine balance, and perhaps they'll benefit from what's happening in a way. There's our question for today. Their latest announcement on output cuts failed to convince the markets. What should it do next? A call for greater cuts, even into as soon as Q1 2024. There was some rumors of another emergency meeting on the news earlier today. Extend cuts through to the end of 24, announce that they, these cuts, these new additional ones should be for the whole year. We had someone yesterday on the program saying they can do that just for sentiment, and then they can adjust their plan as they have been, or stick to the plan. Prices will rise. We'll get a recovery once we see the evidence of these cuts next year. So let's see what our audience thinks there and what OPEC should do next. Andy, just back to you. Let's talk a little bit about COP28, which is still taking place here in the UAE. But there were a couple of announcements when the week kicked off. One of them was that these oil, 50 big oil and gas companies pledging to this methane emission cut by 2030. Is it too little, too late? Do you think we're going to actually see implementation? How this has been a low-lying fruit for a while, hasn't it? So, will we see any action on this, do you think, in the next few years, some serious action by them?
I think a lot depends on I mean, the outcome of COP is one thing, but I think more depends really on the outcome of the US election towards the end of next year. If you get a new administration in the US that has a different view of the role of COP and the US policy towards climate change. Of course, the Biden administration has brought in the IRA, a raft of other legislation to make the US, I guess, a global leader in terms of trying to reduce emissions or at least catch up with Europe, which is a global leader in that space. But I think it's hard to predict the effectiveness of what's been discussed in COP this year against the backdrop of some of these major general elections, which are going to come in OECD countries next year. And you've already had a taste of the mood change amongst politicians in the West in terms of reducing emissions. I mean, you've just got to look at the UK and how the government of Rishi Sunak here has rowed back on some of the legislation of his predecessors in terms of, for example, phase out of the sale of internal combustion engine vehicles, which was due to kick in 2030 when a moratorium, a ban on the sale of new vehicles was meant to come into force. That's been kicked down the road to 2035. Will that again be kicked down the road to 2040 and again to 2045? At the moment, in a lot of these OECD nations, and the same is the case in Europe, where you just had, albeit a rather inconclusive outcome to the Dutch election, but the party that won the largest share of the vote there, again. It hasn't put climate change at the head of its political agenda. So I think that it's driven by the politics, not necessarily by what is said in COP28.
Yeah. Okay. All right. Yeah. Thanks, Andy. Jay, just shipping wise, I mean, obviously the shipping sector and industry is a big emitter. It has its own directives placed on it in terms of the fuels that it uses and emissions. What would it take to get that sector? We hear a lot from that sector saying, we want to commit more to emissions reduction, but we have no clear guidance on policy, and that's what's kind of holding us back. So will there be increased pressure, do you think, on the shipping sector per se?
I mean, there is already some increase in pressure on that sector already, right? The inclusion of shipping into the EU ETS is one factor. But I think from a ship owner's perspective, we have to kind of zoom out a little bit. When you purchase a ship, you're buying a ship for 20, 30 years at a time. And I think just given how much uncertainty there is in the world when it comes to even regional, national, and then even like international level climate policy agreements, it's so hard to decide, okay, am I going to buy a ship which is going to run on ammonia, on methanol, on LNG, or even oil? But yeah, I think I don't envy the position of a ship owner trying to buy a ship and decide what to run as fuel. Yes, there are changes that have come in, as I've talked about the introduction of the EU ETS, and yes, we could see more in terms of CII, but yeah, I think it's very difficult for any ship owner to make any long-term concrete commitments as to how they're going to abate emissions. Of course, efficiency in routes, efficiency in your fleet usage is one thing, and that's always been a thing where ship owners will try to maximize the utilization of their fleet to basically get the most bang for the buck. But yeah, I think it's a very, very difficult question otherwise.
Okay, thanks, Jay. Neil, let me come back to you on the Russia-Saudi relationship a little bit. We obviously had Putin just in the region. I think he's left now, but he came to the UAE, did a whistle-stop tour, UAE-Saudi. I mean, what's your interpretation of the reasoning for that? Do you think it's oil-related, or do you think it's geopolitics? What as in what's happening in the region now? We know that the Gulf hasn't been too involved with its views on Ukraine anyway. So what do you think triggered that now?
Well, I think it's a combination of the oil market and geopolitics. I think that the simplest geopolitical factor is that because of the stalemate in the war in the Ukraine, I mean, clearly at the moment it's going nowhere, if arguably perhaps marginally against the Ukrainians. But Putin feels more confident that he's able to move in circles which have never been overtly hostile to the Russian invasion of Ukraine from the start. And obviously there are wider Russian interests in the Middle East, not least in Syria, but elsewhere. And as far as the oil market is concerned, the declaration of cooperation between OPEC and the other producers remains in place. There are clear pressures, which you alluded to earlier, from the Saudi oil minister about Russia's commitment to the production cuts that it's made. So it's a very opportune meeting and also a very opportunistic meeting from the point of view of Putin. There's a little piece of me which rather hopes that he might turn up to the COP28 meeting to provide us with something interesting going on there, but that hasn't turned out to be the case. But this is Russian opportunism. It's Russia feeling a little bit more confident that in certain parts of the global politics, it can continue to play a role. And I think we should probably be rather worried by that.
Okay, well, there we've got our result: 0%, extend the cuts, okay, wow, through to the end of 2024, which I would have said would have been the most popular, easiest thing for OPEC to do at the moment anyway. Greater cuts for Q1, stick to the plan. Okay, 56%. Yeah, I mean, are you surprised at that, Neil? Just back to you.
Well, I mean, I'm personally a stick to the plan, and I'm afraid suck it up. As I said at the very start, there's only so much you can do.
Yeah.
And we've seen throughout history, way back in the 1980s and at other times, you can keep cutting. But if you can't control demand, you can't control non-OPEC supply, and if you want $100 a barrel, I'm afraid you're going to have to kiss it goodbye until market conditions are more suitable. And I think they just stick with what they've got now and just have to suck up the price.
Okay, Andy, I'll just go back to you quickly on that survey. Where would you have voted?
I mean, I voted, for the last one that I think, people are going to sit on their hands and wait for where demand goes next year. But, just to put into historical context, come back to Neil's point, we had a little bit of a look at this in terms of, what is the purchasing power of oil today compared to adjusted inflation over time last week, and the sort of trigger for this was the sad death of Henry Kissinger, who of course was born in 1927, 2 years before the Great Depression, and at the time a barrel of Pennsylvania Bradford District crude, which was the benchmark for global oil at that point in history, was $3.10. And you adjust that for inflation in today's money, and it's worth $53.90. So actually, not a million miles away from where we are today. And so you can interpret that in two ways. Does that show the success of institutions like OPEC in terms of balancing markets, or does that show their absolute failure in generating more value for their stakeholders, which is ultimately the governments, which rely on their management of the markets to generate revenue? It's an interesting question.
Okay, well, we'll end on that question. Thanks very much to Andy, Neil, and Jay for joining us today. Have a great weekend, everybody. And we probably won't see the three of you until we kick off with our new season in January. So if I don't, wishing you a merry, happy holidays, a vacation time, and we will see you in 2024. Thank you so much.
Thanks a lot.
Thank you so much, and to you too.
All the best.